So we'll start with reading number 29 of the level 3 curriculum that will teach us about risk management using derivatives, more specifically forwards and futures. Reading numbers 30 and 31 will talk about options and swap strategies. So we'll quickly revise the concepts from level 1, 2 and fixed income and equity markets that we're going to need in this review. So first of all of us must be very conversant with the concept of duration or modified duration. That is the percentage change in the price of the bond for a 1% change in the underlying. Similarly, if you are given the modified duration of a bond or of a futures contract, then by applying that definition that we just studied, we can calculate the change in the futures price as the modified duration of the futures multiplied by the original futures price multiplied by the change in yield of the futures. Similarly, if we had a bond, then the change in the bond's price can be calculated as the modified duration of the bond multiplied by the price of the bond multiplied by the change in yield of the bond. The change in yield of the bond is given as the yield beta times the change in the yield of the futures, where yield beta is defined as the percentage change in the yield of the bond for a 1% change in the yield of the futures. We studied this concept at fixed income securities when we studied the basics of fixed income securities. Similarly, we've studied earlier beta of the stock is defined as the covariance of the stock with the market upon the variance of the market. Now please remember that the beta of the stock calculated as before is nothing but the percentage change in the stock price for a 1% change in the market. The higher the beta, the more volatile will be the stock, or the more volatile will be our portfolio. The lower the beta, vice versa. Oftentimes, the objective of risk management of equity positions would be to alter the beta of the portfolio. If you're expecting the stock markets to go up, you would want the beta to be high. If you're expecting the stock market to go down, you would want the beta to be low. The number of contracts needed to change the beta of the portfolio from beta P currently to beta T, that is target, can be given by this formula. We will soon derive this formula. Beta T is the desired portfolio beta. Beta P is the current beta. Beta F is the beta of the futures contract that we are using to achieve this transition. VP is the current value of the portfolio, and PF is the price of one future. PF into the multiplier will be the price of one contract that we can purchase. So let's assume that the current beta of the portfolio is beta P, and let's assume the stock market goes up or down by delta Y. Let's assume it goes up by delta Y. Then at the moment, the change in the value of the portfolio will be equal to VP into beta P into delta Y. The fund manager, however, wants that his portfolio should behave as though the beta is equal to beta target. So the fund manager wants that the actual change in the value of the portfolio should be equal to VP into beta T into delta Y. So what we want is that we want to change the beta of our portfolio from beta P to beta target. What we have at our disposal is a futures contract with a beta of beta F. Let's assume that we long N contracts. So if we long N contracts, the value of those N contracts will change by N into the value of one contract into delta Y into the beta of the futures. Value of one contract is nothing but the futures price into the multiplier. So we call this the value of one futures contract. the stock or the existing portfolio will go up to this extent. The futures portfolio will go up to this extent, that is N into VF into beta F into delta Y. The whole change we want should be equal to VP into beta target into delta Y. Delta Y will get cancelled. VP, beta P, beta T, beta F are all known. The only unknown here is N, which can be derived as beta target minus beta portfolio into the value of the portfolio divided by the value of one futures contract, or beta F into one futures contract. This is the formula. You can remember the formula if you've solved enough questions. Even doing it like the way I have done, or even solving it the way I have done, is not going to be any problem at all. So let's do one question and understand the concept better. A manager of a $10 million portfolio wants to increase the beta from the current value of 0.9 to 1.3. The beta on the futures contract is 1.06 and the total futures price is $350,000. Calculate the required number of futures contracts to achieve a beta of 1.3. Calculate the required number of futures contracts to achieve a beta of 0. So for a beta of 1.3, we can again substitute in the equation that we've just derived. The target beta is 1.3. The current beta is 0.9. The value of the portfolio is equal to 10 million. The value of one futures contract is 0.35 million and the beta of the futures is 1.06. So N comes out to be 10.7 or approximately equal to 11 contracts that will need to be longed. Please note this N was the assumption that we are longing N contracts. Similarly, let's solve part B, that is calculate the required number of contracts to achieve a beta of 0. So in a similar manner, the target beta now is 0. The beta of the portfolio is equal to 0.9. The value of the portfolio is 10 million. The beta of the futures still is 1.06 and the value of one futures contract is 0.35 million, giving us the number of contracts as equal to minus 24.25. Please note, your assumption of long or short won't really matter. If your assumption is wrong, the answer automatically will come out to be negative. So if we are long N contracts and N is minus 24.25, it implies that we need to short 24.25 contracts to achieve a beta of 0. Now very interestingly, the same concept can be used to create a synthetic stock position. Let's assume I'm holding treasury bonds in my portfolio. Or rather, I'm holding cash in my portfolio because my view is that the stock market is going to go down. There is a big event happening, and I think that while my long-term view is correct, in the short run there can be a rally because of that event or as that event plays out. So just for the next 1 month, I want to create a stock position or a benchmark position, but then I will wind it up and come back to my cash position. So only for a month I want an equity position in my portfolio. Now just for 1 month, if I go about buying all the stocks and then selling all the stocks, first of all I may not have the liquidity, and second of all I'll incur too much brokerage and transaction costs. So very often I can use the help of equity futures and construct a synthetic stock position in the same manner. Now let's assume that the amount of treasury securities that I hold right now, or the value of the cash that I hold right now, is equal to T held. And let's assume that I want to equitize this position. That is, I want to make the beta of this position equal to 1 or make the beta of this position equal to the market beta. Now let's assume that VF again is the value of one futures contract. The beta of the futures contract is assumed to be 1 since it's a futures on the index itself, and the beta of the index can be assumed to be 1. At the moment, if the market changes by delta Y, the value of this treasury position will change by the value of the treasury position into 0 into delta Y, because the beta of the portfolio is 0, so it won't change. What I want is that the value of the treasury position should change to the extent of beta, that is 1 into delta Y. That is, it should change to the extent the market goes up. To achieve that, I again have a futures of value VF and beta F, that is again assumed to be 1 into delta Y. So this entire change with this futures contract should be equal to the treasury position into delta Y, that is the target, and this is the current plus the futures. Now if my time horizon is for T years or T months, that is the time for which I want to keep the position equitized, then if I have T dollars kept in treasuries today, then that T dollars would become T into 1 plus R to the power T after that time horizon. So effectively this is the amount that I can equitize, because I don't want to have any cash in the portfolio. If I equitize less than this, then that remaining RF will not go up in line with the market. So I want the entire position to go up in line with the market. So the value or the number of contracts that I need to purchase would simply be equal to the treasury position, that can be calculated as T held into 1 plus R to the power T divided by the value of one contract. The beta of the contract is assumed to be 1, or T into 1 plus R to the power T upon VF will be the number of contracts that I need to long if I want my portfolio to behave like an index or with a beta of 1. Because I'm using index futures, beta is assumed to be 1. The only problem with this approach would be that this n, as we just saw, may not always be a round number. N can be 10.8, it can be 5.6. However, longing 5.6 contracts is not possible. So what we normally do is, if it's 5.6, we'll long 6 contracts. If it's 5.2, we will long 5 contracts. So we'll round it off and long as many number of contracts. Hence, there is a part of our position that will either not be equitized if I'm longing less contracts, or that will be over equitized if I'm longing more contracts or rounding on the positive side. So the actual T equitized can be calculated by the reverse of this formula. It will be the number of contracts rounded, that is the number of contracts that I bought, into PF into the multiplier divided by 1 plus RF to the power T. So even though I wanted to equitize a position of T held, I may have either over equitized or under equitized, because I am allowed to purchase only a rounded number of contracts. So this will be the treasury or the amount actually equitized. Let's understand one example. A manager has created 150 million in treasury bills with a yield of 5%. For the next 6 months, the manager wishes to have a synthetic equity position approximately equal to this value. The manager chooses S&P 500 index futures, and that index has a dividend yield of 2%. The futures price is $1,500 and the multiplier is $300, calculate the required number of contracts. Please note the dividend yield of 2% makes no difference to the calculation, okay? It is just a distractor. So please solve the question as you have studied. So the number of contracts would be equal to the treasury position held into 1 plus r to the power t, t will be 0.5 in this case, divided by the value of one contract. The treasury position held is 150 million into 1 plus 0.05 to the power 0.5 upon the value of one contract, that is equal to 1500 into 300 divided by 10 to the power 6, or we can simply multiply this by 10 to the power 6 to make 150 million, which will give us 341.57 or approximately 341.6. So then we will end up longing 342 contracts to completely equitize this $150 million equity or treasury position. If we are asked that what is the effective amount of equities that we have purchased, it will actually be this entire amount. It will be the entire $150 million divided by or reduced to the extent of the dividend yield, because taking a futures position gives us the same capital position or gives us the same capital appreciation as the underlying bonds or the underlying equities would. As the underlying equity price goes up, the price of the futures will also go up. However, taking a position on the futures will not give us the dividend yield, if any, in the index. So the effective amount of stock purchased would be slightly reduced to the extent of the 1% or 2%, whatever be the dividend yield on the index, because we equitized using futures. Had we sold this 150 million and bought the index exactly, we would have gotten the capital appreciation also and we would have gotten the dividend yield also. Now we will only more or less get the capital appreciation and not the dividend yield. So I've asked, just note, the effective amount of equities purchased is the same amount, that is number of contracts into the multiplier divided by 1 plus the dividend yield to the power t. So we purchased 342 contracts that will actually equitize slightly more than 150 million. So we will actually end up equitizing $150.2 million because we are buying slightly more. That is 342 into 1500 into 300 divided by 1.05 to the power 1 by 2. Just like we equitized a cash position, we may be required to do the opposite. So we have an existing portfolio with a given beta, or if it's an indexed portfolio, the beta is 1. And what we are required to do is create synthetic cash. So what we are expecting is that in the short run, the market may crash big time. There is a big event, and for that event, I don't want to be exposed to the market. Generally, of course, my long-term allocation dictates that I should have so much exposure to equities. So I don't want to change my exposure to equities, but for this 1 month, I don't want to be invested in the markets. So for 1 month now, I want to create synthetic cash. So if I have to create synthetic cash, then essentially I want the beta of my portfolio to be equal to 0. Let's assume the value of the portfolio currently is VP, and if this entire VP was cash, then at the end of period T, this VP would have become VP into 1 plus RF to the power T, because it is cash. Cash doesn't mean zero return. Cash means I want to earn the risk-free rate of return on this portfolio. So this VP should not be moving with the market, it should just be a value of VP into 1 plus R to the power T. So if this is the value that I want, then the number of contracts needed to make a target beta equal to 0 can be calculated as minus beta of the portfolio, which we will assume to be 1 since it's an indexed portfolio, upon the beta of the futures, which can also be assumed to be 1 since it's an index futures, into VP into 1 plus RF to the power T divided by the value of one futures contract. So the number of contracts needed would be VP into 1 plus R to the power T upon PF. Please note there will be a minus sign because 0 minus 1 will be minus 1. That means we need to short so many contracts to create synthetic cash. There's a slight difference between creating synthetic cash and creating a zero beta portfolio. If the question asks that I want to reduce the beta to 0, then don't multiply with this 1 plus RF to the power T. This VP I just want to make a beta 0. If the question says create synthetic cash, that means it has to generate an RF return also. So we'll short VP into 1 plus RF to the power T. Assume a pension fund has a $15 million large cap position, and fund managers have a bleak outlook for market performance over the next 6 months. So they want to create synthetic cash approximately equal to the position. 6-month futures are currently at 1500 with a multiplier of 300, and 6-month treasuries are yielding 3.6%. Calculate the appropriate number of contracts and determine the appropriate position in the contracts. So the value of the portfolio is 15 million. The risk-free rate is 3.6%. So 1 plus 0.036 to the power 0.5 divided by the value of one contract, that is 1500 into 300. Again, we'll multiply 15 million as 15 into 10 to the power 6. That will give us the number of contracts we need to short if you want to bring down the beta from 1 to a value of 0. Again, it's a large cap position, so we're just assuming that the beta would more or less be equal to 1, even though it has not been explicitly mentioned. So if you generally remember this formula, you shouldn't have any problem solving questions of this type. And how to derive this formula, please watch in the video again if at any point in time you forget how we've derived the target beta of the portfolio from the existing beta using the beta of the futures, which comes out to be minus 33.93. So we need to short approximately 34 contracts to create synthetic cash, exactly the opposite of creating synthetic equity. The proof of the duration formula is exactly similar to the proof of the beta formula. So if you didn't understand it then, please pay attention now. We're going to do the exact same process and learn how to change the modified duration of a fixed income portfolio from a given level to a target level. So what is the number of futures contracts that we need to long or short to change the duration of the portfolio from MDP to MDT? MDF is the modified duration of the futures, VP is the value of the portfolio, PF is the price of the future, PF into the multiplier will be the value of one futures contract. This is the number of contracts N that we need. So we'll solve it in exactly the same manner. Let's assume yields go up by delta Y. There we assumed market went up by delta Y. If yields go up by delta Y, what will be the change in the value of the portfolio? It will be minus of the value of the portfolio into the modified duration of the portfolio into delta Y. What we actually want is that the modified duration should behave as though it is the target and not DP. So what we want is that the change should be equal to minus VP into target modified duration into delta Y. What we have with us is a futures contract let's assume again that we long n contracts. If we long n contracts, the value of these n contracts will change by minus n into the value of one contract into the modified duration of the futures contract into delta y. For the moment, I am assuming yield beta is equal to 1. That is, the change in the futures yield is the same as the change in the bonds yield or the spot yield. So once again, delta y will get cancelled. This will be the total change in my current position with the futures and the portfolio. I want the total targeted change should be equal to VP into the target modified duration. So we need only now calculate n. That will be calculated as, so we'll take n on the right hand side and we'll bring everything else on the left hand side. So n into VF into modified duration of the forward will be equal to VP into modified duration target, we brought this side, minus VP into modified duration of the portfolio, or n can be given as VP is constant, or VP is common rather, modified duration target minus modified duration of the portfolio into the value of the portfolio divided by the value of the futures or the value of the contract or one contract upon the modified duration of the futures. Please note, in this question, if a yield beta was given, that is, yield beta is not equal to 1, it is 0.8 or 1.2 for instance. And remember, yield beta is the percentage change in spot or bond yields for a 1% change in futures yields. So if the yield on the bond has changed by delta y, or the yield on the futures has changed by, or the yield on the spot or on the portfolio has changed by delta y, then that will be when the yield on the futures has changed by delta y upon beta. Because if this changes by delta y divided by the yield beta, then the spot will change by delta y upon yield beta into the yield beta, that is delta y. You can either substitute it like this, or you can say that the yield on the futures changes by delta y, hence the yield on the spot will change by delta y into yield beta. Both will give you the same answer. Here also the change will be delta y into the yield beta. Either you multiply both the portfolio by the yield beta, or you divide the futures by the yield beta. Both will give you the same answer, that the number of contracts needed would be the yield beta into the target modified duration minus the modified duration of the portfolio upon the modified duration of the futures into the value of the portfolio divided by the value of the futures. Please take a second and try to remember the formula, both the formula. It's very similar. This will be beta target minus beta portfolio upon beta of the futures, no yield beta complications in equities, into the value of the portfolio divided by the value of one futures contract. So formula is exactly the same. It may actually make sense to remember this formula because it has multiple applications. You know, it is not very tough to derive also if you forget. A manager has a bond portfolio worth $1.0548 million. The total futures price of the appropriate contract is $0.1 million. The modified duration of the portfolio is 2.35 and the duration of the futures contract is 2.1. The yield beta is 1.5. Calculate the number of contracts to reduce the duration to 2 calculate the number of contracts to increase the duration to 4. So first let's reduce the duration to 2. So the number of contracts would be the yield beta multiplied by the target duration minus the current duration divided by the duration of the futures contract into the value of the portfolio, that is 1.0548, divided by the value of one futures contract, that is 0.1031, which will give us n as minus 2.57, or we need to short approximately 3 contracts to reduce the duration to 2. Similarly, to increase the duration to 4, the yield beta remains the same. It will be 4 minus 2.35 divided by 2.1 into 1.0548 upon 0.1031, which comes out to be 12.06, or we need to long approximately 12 contracts. If we can convert equity to cash and we can convert cash to equity, similarly, if we can make the duration 0 and we can also make the duration positive, then can we actually change our debt allocation synthetically into an equity allocation and change our equity allocation into a duration of 6 or into a debt allocation? Simply make the beta 0 and then the duration positive, or simply make the duration 0 and then the beta positive to convert from debt to equity and vice versa. So to reallocate an amount from equity to bonds, remove all systemic risk from the position by shorting equity futures. Add duration to the position by going long bond futures. To do vice versa, remove all duration from the position by shorting bond futures. Add systemic risk to the position by going long equity futures. So a manager has an 80 million portfolio that consists of 60% stock and 40% bonds. The beta of the stock position is 0.6 and the modified duration of the bond position is 6.8. The manager wishes to achieve an effective mix of 70% stock and 30% bonds. Since the move is only temporary, and rather than having to decide which bonds to sell and which stocks to buy to achieve the desired mix, the manager will use futures contracts. The price of stock index futures is 0.5 million and its beta is 1.2. So 10% of the total portfolio has to be converted from bonds to equity. So 10% of the total portfolio would be a value of 10% into 80, that is $8 million. So $8 million of bonds have to be first converted to a duration of 0 and then taken up to a beta of 0.6, because that is the beta of our equity position. So the 6.8 has to first become 0 and the 0 then has to become 0.6. So the number of contracts needed to make the duration 0 would be equal to the target duration minus the current duration divided by the duration of the futures, that is 9.2. Since yield beta is also given, we will multiply it with the yield beta of 1.1 multiplied by the value of the portfolio, that is 8 million, multiplied by the value of one futures contract, that is 0.15 million. So N comes out to be minus 43.3. So approximately 43 bond futures contracts need to be short. What this would do is create 8 million of the bond position to a duration of 0, or practically like cash. And we would immediately then long a corresponding number of equity futures contract to make a beta equal to 0.6. So these are the bond futures. Now let's calculate the number of equity futures that we will need. The target beta is 0.6. The current beta for this 8 million is 0. Duration is 0, beta is also 0. The beta of the futures contract is given to be 1.2 for the equity futures. The value of the portfolio is 8 million and the value of one futures contract is 0.5 million. So the number of equity contracts needed would be equal to about 8. So we need to short 43 futures contracts and long 8 stock futures contracts to convert 10% of the bond position into an equity position. A manager of 30 million of mid-cap equities would like to move 60% of the position to small-cap equities. The beta of the mid-cap position is 1.3 and the average beta of small-cap stocks is 1.6. The betas of the corresponding mid and small-cap futures contracts are 1.1 and 1.4 respectively. The mid-cap and small-cap futures total prices are 0.3 million and 0.25 million respectively. Determine the appropriate strategy. So once again, 60% of this position has to be first converted into cash, or first taken to a beta of 0 and then taken to the beta of the small cap stocks. To take the position down to 0, we will take the help of mid cap futures. To take the position back up to the small cap beta, we'll take help of the mid cap futures, or rather small cap futures. So 60% of the position would be 60% into 30, that is equal to $18 million. So the number of contracts needed would be equal to the target beta. First we want to bring the beta down to 0, minus the beta of the mid-cap position, that is 1.3, divided by the beta of the mid-cap futures contracts, that is 1.1, into the value of the mid-cap position upon the value of one futures contract, that is 0.3. So this will come out to be minus 70.9, or approximately 71 contracts is what we will need to short of the mid-cap futures. And then we want to take the beta back up to 1.6, that is the beta of small cap stocks. So the target beta now is 1.6 from an original beta of 0. We have help of a futures contract that has a beta of 1.4. 18 million is the total position divided by 0.25, that is the value of one futures contract, which comes out to be 82.28. So 82 contracts approximately of the small cap futures is what we need to long, and 71 contracts of the mid cap futures will short to execute this change. The same concept can be used to execute pre-investing. So when I know for sure that I'm going to receive recurring cash flows, or I'm going to receive a particular cash flow, then I may want to pre-invest it, that is invest it today itself, because if the market rallies from today till the time I receive the cash flow, then I don't want to miss out on that market rally. So I know for a fact that this cash is going to come 1 month later. Pre-investing means I'm investing as though I've received it today, because I don't want to leave the upside in that 1 month. A portfolio manager knows that 7 million in cash will be received in a month. The portfolio under management is 60% invested in stock with an average beta of 0.8 and 40% invested in bonds with a duration of 3.5. The most appropriate stock index futures contract has a total price of 0.35667 and a beta of 1.07. The most appropriate bond index futures have a yield beta of 1, an effective duration of 7.7 and a total price of $121,000. Determine the appropriate strategy to pre-invest the $7 million in the same proportion as the current portfolio. So if we want to pre-invest in the same proportion, that means 60% or 4.2 million of this portfolio has to be invested in stocks, that is a beta of 0.8, and 40% of this portfolio, that is 2.8 million, has to have a duration of 3.5. So we will first compute the stock position, that is the target duration, or rather the target beta minus the current beta because it's cash that's going to come, divided by the beta of the futures contract, that is 1.07, into the value of the equity position as 4.2 million divided by the value of one futures contract. So we need to long approximately 8.8 contracts. Similarly, for the bond futures, the yield beta is given to be 1. $3.5 is what the target duration that I want. 0 is the current duration. 7.7 is the modified duration of the futures contract into 2.8 million divided by 0.121 million, that is the value of one futures contract. So we need to long approximately 11 bond futures and 9 stock futures. We can take the help of forwards and futures to help us with our exchange rate risk as well. Only now we will have to long or short currency forwards and currency futures. Now, when investing in currencies or when investing across geographies, there is 3 categories of exchange rate risk that we broadly face. First is called the economic exposure, that is the loss of sales to the domestic exporter due to currency changes. So if the domestic currency appreciates, he may be receiving more in value for whatever he has already sold. If the domestic currency appreciates, first of all, he will end up receiving less in value for whatever he has sold. And if he charges in the domestic currency, the foreigners may not be able to afford the product because it will now cost them more in their currency to buy from the exporter if the domestic currency has appreciated. So economic exposure is the exposure that some sales will be lost if the home currency appreciates. If the home currency depreciates, then the exporter will become more affordable to the rest of the world, his sales will increase. Vice versa is the economic exposure or the economic loss. Translation exposure is the exposure that multinational corporations may see a decline in the value of their assets, especially when they make the consolidated balance sheet at the parent level. We studied currency translation, the temporal and the all current method at level 2. So when we are translating, if the domestic currency has appreciated, then the foreign currency assets will look lesser in value in the domestic currency because the domestic currency has become higher in value. And finally, there can be a transaction exposure, that is, transacted future transactions may lose value. So if I have agreed to receive money in the foreign currency and I have already transacted, that is, I have agreed to sell products in pounds, so I am expected to receive 100 pounds every month for the next 12 months. Then if the US dollar appreciates or the pound depreciates, then these 100 pounds will lose value in US dollar terms. So once again, Economic exposure is the risk that sales may not happen at all because somebody else has become now more affordable than me. I was competing with somebody, and because my currency appreciated and the other's currency depreciated, he has become more affordable, so I have lost some sales. Translation exposure is that in translating or in reporting the consolidated books, the value of the assets will now decline. Transaction exposure is that transacted items will now bring me lesser in dollar terms or in my domestic currency because my domestic currency has appreciated. So if I'm contractually receiving the foreign currency, then I will be said to be long in the foreign currency. If I'm long in the foreign currency, I should short a forward contract. If I'm paying foreign currency, or if I have contracted to pay somebody 100 pounds, then I'm short the pound. To hedge my risk or to hedge the fluctuation in value, I should long a forward contract or buy the foreign currency in the forward. We'll study in more detail with examples. Big Ben is a UK-based maker of large industrial machines and has just received an order for some of its products. The agreed upon price is 10 million US dollars and the delivery date is 30 days. The current exchange rate is pound 0.74 per dollar and the 30-day forward rate is 0.76 per dollar. Explain the best way for Big Ben to hedge the corresponding exchange rate risk. He is a UK based maker who will receive payment in US dollars. So his current position is long the US dollar. So if he is long the US dollar, to hedge his risk, he needs to short the US dollar. Please remember, when we long a currency or we short a currency, it is always the foreign currency that we are talking about. So this quote is a direct quote in pounds. That is what we need. It is 0.76 pound per dollar, not dollar per pound that we are used to seeing. So this is a direct quote in the pound. That is the quote we need if we have to short the dollar. So whenever you are longing or shorting, please remember, it is the foreign currency that you are longing or shorting. That is, it should be in the direct quote of the domestic currency. The domestic currency in this case is the British pound. These quotes are correct because these quotes are pounds per dollar. So I will short dollar at 0.76 pounds per dollar. That is, I have agreed to receive 0.6 into 10 million pounds, or dollar may go wherever. I will receive 7.6 million pounds. If the dollar actually appreciates, it becomes 0.78. I will lose. But if the dollar depreciates, I will gain on this forward contract because my position is fixed, or I will receive 7.6 million pounds. Gain on spot will be offset by the loss in future and vice versa.